So I've been asked to speak to you today about what is the African perspective on what's happening at the OECD inclusive framework on the so-called Pillar 1 and Pillar 2 rules, which I'm sure you're all pretty familiar with. And that you may be aware that there are 26 African countries that are members of the inclusive framework, which is roughly 50% of the continent. So 50% are not and 50% are. The African Tax Administration Forum, albeit that the name, as it suggests, we largely deal with administration issues. We also have been providing some advice to countries in the tax policy space. And now we have a close partnership with the African Union, which has better access to African finance ministers. And so more and more we're doing work in the tax policy space. And on the Pillar 1 and Pillar 2 proposals, we've made quite a number of inputs to the OECD over the past couple of years. And that, that culminated in ATAF making an alternative proposal on Pillar 1 in May this year, which I'm not sure, but some of you may have seen. So I'm going to primarily focus on the key areas of the Pillar 1 and Pillar 2 rules in the current proposal, albeit that there's a debate about what is the current proposal, but maybe starting with the blueprint. It's back in October last year. And then set out what some of our concerns are in Africa and how that informed the proposals that we made to the OECD. And I'm sure you're all aware that in the past couple of weeks, there's been a significant political momentum to try to reach a political agreement by what is essentially the early part of July, with the G20 finance ministers meeting takes place on the 8th and 9th of July. The inclusive framework meets on the 30th of June and the 1st of July. That's the meeting where countries will either agree to join some sort of solution or will say they don't want to join that solution. So things are speeding along quite quickly now. And have probably moved on quite a bit, in fact, since we made our proposal. And I'll try to talk to you a little bit about where we think our proposal may be reflected and where we think it's probably not going to be reflected if there is an agreement at the end of the month. And so I'm going to suggest that I probably will stop at a couple of points in the slides, give you an opportunity to ask me some questions or seek any clarification. I've got 21 slides and I gather I've got about 25 minutes, so that's a bit of a challenge. So some of the slides I might skip over a bit, where maybe we think things have moved on a little bit. And let me try putting them on presentation mode. Okay, hopefully you can still see them. Please shout if you can. Okay, so what is it we were concerned about in terms of the blueprint? Strangely, in some ways, similar concerns than many of the public comments made, which were, we thought the blueprint proposals were far too complicated, and they appeared to result in little reallocation of profits to the smaller market jurisdictions, which obviously is many of the African jurisdictions. And in this partnership we've got with the African Union. The African Union at the Inclusive Framework meeting in January 2021 set out those concerns that we had regarding the blueprint. And so following the meeting in January, our membership, so we have 38 countries that are members of ATAF, our membership asked us to explore developing an alternative approach to Pillar 1 that will both simplify the rules and result in a greater allocation of profits to market jurisdictions. So there were some areas which we felt were particularly complex. So you may have seen in the so-called Nexus rules, the idea of having so-called plus factors. We also were concerned about the segmentation rules, and the issues about ADS, automated digital services, and CFB, consumer-facing businesses. We thought those were artificial distinctions and led to a lot of the complexities in the rules. So we wanted those two things removed. On the profit allocation, our concern was why a 10% deemed routine profit, firstly, why 10%? And secondly, why allocate 20% of the residual profit rather than another percentage of the residual profit? I'm sure you've seen that in the economic impact assessment, the OECD estimated that those two numbers, a 10% routine profit and a 20% of the residual being allocated to amount A, would lead to roughly $100 billion of profit being reallocated. So with the 10% routine profit, bear in mind also the in-scope multinationals at this point were those with a turnover of more than 750 million euros. So these numbers were based on that, not based on the recent US proposals, which would only bring about 100 multinationals into scope. So the total residual on a 10% routine profit was about $500 billion. So 20% of that is around 100 billion. And you can see at the bottom, a little bit of impact for lower income countries, but not a significant amount. We also thought we also struggled with how the rules created a level playing field. So the way the rules work, first of all, the multinational still allocates out all of its profits using the current profit allocation rules, so essentially the arm's length principle. So that will result in a situation where, let's call it a traditional business, which has a taxable presence in a country, there'll be an allocation of some profit under the arm's length principle. And as here, we're looking large distribution type activities. That's likely to be a fairly routine level of profit. And then on top of that, it will receive this additional amount A, which is reallocated as a type of second step after the first allocation. So if you're a traditional business, you'll be taxed in the market jurisdiction on your arm's length profit, likely routine, plus this additional tax under amount A. But if you are a business which does not have a taxable presence, so an automated digital service type business, or what some people would refer to as a scale without mass business, then you will not be taxed on any profit under the arm's length principle because you don't have a taxable presence in the country. So none of your routine profit will be taxed in that jurisdiction. All that will be taxed is amount A. So a traditional business which has the same profit margins as a digital business, the amount A will be the same in both cases. So the traditional business will end up paying more tax in a market jurisdiction than a digital business. And we thought that was not very equitable, and we didn't see a policy rationale for that. And finally, one of our concerns was the so-called nexus threshold. I mentioned to you, we didn't see there was a need for plus factors. We thought that created a lot of complexity. We also thought that you shouldn't have just one revenue threshold for all markets. So we are in favor of one revenue threshold with no distinction between CFB and ADS businesses, but we were not in favor of the same nexus threshold for a country with a 20 billion euro GDP and a country with a 20 trillion euro GDP. For us, that didn't make any policy rationale sense, because what we're looking at here is whether the business participates, as it says on the slide, in a significant manner in the economic life of the market jurisdiction. So what is significant sales in a jurisdiction with a 20 billion euro market is very different than one that's got a 20 trillion euro market. So we didn't like that proposal. Pillar 2. We think that the minimum effective rate, and this has moved on quite a lot since we made our initial comments. So we said we thought it needed to be in excess of 20% if it was going to be effective in dealing with profit shifting in Africa. So most African countries, not all of them, of course, but most of them have a CIT rate, statute rate of somewhere between 25 and 35%. So if you have a minimum effective tax rate of, say, 12.5%, which perhaps when we wrote to the OECD was what we thought would be happening, you're still talking about a pretty big differential between that rate and the statutory CIT rate in many African countries. So in our view, there still was quite a big incentive to profit shift. Of course, things have moved on quite significantly since then, with the US firstly proposing a minimum effective rate of 21% based on the Biden administration saying it wanted to push the statutory rate back up to 28% and the guilty up to 21%. We know, of course, that since then there's been some movement back from that. And now you see in the G7 communique, the talk is of at least 15%. So we may have a floor of 15%. We would like to see it higher than 15%. But of course, there are some jurisdictions who would like to see it lower than 15%. So we'll have to see where we get on that. And we were aware, of course, that the OECD Impact Assessment Report says there's far more tax at stake under Pillar 2 than there is under Pillar 1. And we think that the way the rules were written back then was that they seem to favour residence countries. Most of that tax shield would go to countries that were resident countries because the income inclusion rule takes priority under the undertax payment rule. So it seems to us that the rules will perpetuate this issue of favouring residence jurisdictions in the allocation of taxing rights to the detriment of source jurisdictions. And as I'm sure you're aware, probably with the exception of South Africa, African countries tend to be source jurisdictions. So we didn't see a policy rationale for that. And it was interesting to note in the public comments that a lot of businesses shared that view, actually. And they also agreed there didn't seem to be a policy rationale for how you allocated the top-up tax between the residence and source countries. So bearing in mind that we're told that having the undertax payment rule as the primary rule is too technically difficult to design, we've been pushing for the subject to tax rule to have some different status. So you're probably aware the way the rules work is strictly the subject to tax rule comes before the income inclusion rule because it's a treaty-based provision, and you apply every other rule in tax before you apply what they call the globe rules, which is the income inclusion rule and the undertax payment rule. So strictly it would come first, but of course it's irrelevant unless countries put it in their treaties. And we thought with African countries, it's unlikely their treaty partners will agree to put it in their treaties. So our proposal has been to call for the subject to tax rule to be mandatory for all inclusive framework members to include in a treaty where the treaty partner wants it to be included. So if you've got two treaty partners who don't want it, then fine, it doesn't have to be included. But where one does, we wanted it to be included. And we also wanted a far broader in scope subject to tax rule. So we wanted the subject to tax rule to cover interest and royalties, which has pretty much been agreed, but also to cover service type payments, management fees, etc., and potentially to also cover capital gains, which is very similar actually to the proposals put forward by the G24. And so let me just stop there for a minute. I've realized I've taken, I think, 15 minutes so far. So let me stop there and ask if anybody's got any questions before I talk you through what we said in our proposed Pillar 1 rule. So let me start. And apologies for the dog. one of the downsides of working from home. Does anybody have any questions at this stage?
Yes, this is Thomas from the Netherlands. At the beginning, you mentioned that few of your proposals would have more chance of being implemented than others. What are the things that you are suggesting from an African perspective you think have a good chance of success to being implemented in the final proposal?
It's a very good question. So I think some of it's, political reality. Many of our simplification proposals are very similar to those that were made by the US. So in that way, I think we've got a good chance of getting those proposed. So, for example, we said no segmentation. The US essentially says no segmentation except in very limited circumstances. And I think the primary goal there is to make sure that Amazon is within the rules, and maybe a few other companies as well. So we're happy with that limited exception idea. So that I think is if there is an agreement, I think that's likely to succeed. No plus factors, I think that will succeed. I think there will be what I call a tiered approach to the Nexus rules. So there'll be a lower Nexus for the smallest economies and a higher Nexus for the other economies. The removal of ADS and CFB. So again, like the US, we wanted a more comprehensive scope in terms of who was included and who is excluded. And we seem now to be in a place where all multinationals sector-wise will be included except extractives, natural resources, and possibly financial sector. Although I don't think that decision is final yet. And what do we mean by the financial sector is certainly seems to be open to a bit of debate. We're pretty comfortable with that part of the proposal. I think we have members who want the financial sector to be included, and we have members who don't want the financial sector to be included. So one of the things that we now face probably as an organization for the first time is we don't necessarily have all our members saying exactly the same thing. So we obviously have to reflect that in what we say. But I think much of that simplification rule, I think we've got a good chance of getting. I think we've got a chance of getting a reasonably broad subject to tax rule and some sort of targeted minimum standard. So when I said should be included in treaties where one of the treaty partners requests it, I think some sort of targeted version of that may be the outcome of the negotiations. So I think they're the main ones. And when I go through the Pillar 1 proposal, I'll perhaps stop and say to you, these are the areas where I think we've got a good chance, and these are the areas where it doesn't look so promising for us. Thanks.
I have got a question, Hailey. With the progress which is being made regarding Pillar 1 and Pillar 2, is there a move for more African countries to become members of the inclusive framework?
It's a very good question. As an organization, we don't tell countries who are members of ATAF to join or not to join. We will provide them with sort of an overview of what we think are the benefits and what are the costs of joining. I think what you're going to see, of course, is an issue. What happens if there is an agreement? What happens if you're not an inclusive framework member? So in the G7 communique, it talks about withdrawing DSTs and similar measures for all companies. And that in itself is an interesting observation, because it indicates you're going to have to withdraw DSTs for multinationals who may not be in scope of Amount A, which some countries I think have already picked up. But if you're not a member of the inclusive framework, what will happen if you've got a DST? Will you end up with trade tensions with the US because you've got a DST, even though you're not an inclusive framework member? Will you be subject to a Section 301 investigation? So will that maybe make countries think, well, I better join the inclusive framework? Can you, looking at the other side of it, it looks likely that to implement probably both Pillar 1 and maybe parts of Pillar 2, certainly subject to tax law, there'll need to be another multilateral instrument. So open question is, if you're a country that's not a member of the inclusive framework, can you sign the multilateral instrument without being a member of the inclusive framework? I don't know. Don't know the answer to that question. I don't think that decision's been made yet. What will the EU do? If there's a deal, will the EU do what it did over the inclusive framework and blacklist countries who either don't join the inclusive framework or don't implement the 4 minimum standards? So in an African context, Namibia was blacklisted by the EU and essentially forced to join the inclusive framework. Eswatini was on the grey list, and I would argue probably was also forced to join the inclusive framework by the EU. So will the EU adopt a similar type of blacklisting approach to countries who are not members of the inclusive framework? Will the US take trade sanctions if you introduce a DST or another similar type measure? So I've got a feeling some of these countries, yes, will come under pressure to certainly sign up to the rules. Whether that means you have to sign up to the inclusive framework, maybe not so clear, but I think there will be pressure to sign up to some of these rules and to remove things like DSTs if you happen to have them and you're not a member of the inclusive framework. So Zimbabwe, for example, has a type of type of enhanced PE type rule, which allows them to tax digital services at source. Now, Zimbabwe is not a member of the inclusive framework. So if there's an agreement, will it be pressurized to remove that rule? We don't know at the moment, but I think it probably will be. Thanks.
Thank you.
Okay, probably in the interest of time, I should move on. So what did we say in our proposal? Let me just, the slide frozen, so there it goes. Okay, so some of these I think I've just covered really. We said that we should do it, we should have this comprehensive scope, so this was similar to the US. Everybody should be in, irrespective of their sector activities, with the exception of the exclusions that were in the blueprint, which were essentially extractive natural resources and possibly the financial sector. So as I said, Thomas, this is probably one where we think the momentum is there. It's what the US want as well. So the momentum is probably there. We wanted one measure of the nexus threshold. We wanted that to be a revenue threshold, essentially, including this concept of user participation, and not differentiate by business models and no plus factors. I think we're going to get there as well. I think that's the way it's going. If there's an agreement, I think this pretty much we will get what we want here. This what we call a tiered approach, so different levels. And actually, let me show you. Maybe I can move on. This was what we proposed. This was illustrative. It was more to illustrate the point. We weren't necessarily these had to be the number. But if you look to the dark green column where it says GDP in billions, these are not our segments. These were the segments used in the OECD impact assessment. So we just picked them because they were there. So you can see that we are suggesting a different sales revenue threshold for smaller economies than bigger economies. We think that's more of a policy rationale issue. We realise that actually, if you take the US proposals, if you've got a 20 billion revenue threshold and a 10% profit margin, so your smallest M&E with will be, say, 20 million, and it will need to therefore generate profit of more, 20 billion. It will need to generate profit of more than 2 billion. So let's say it made 11%, it'll have 200 million residual, of which 20%, you're going to be allocating 40 million of that. If you've got a revenue threshold of 250,000, you're not going to get a lot of money out of that. We saw this more as an issue of principle, and obviously for some of the very, very big multinationals, the numbers still could be quite big. But we also think, as a matter of principle, the smallest economies should not be cut out of these rules. Also, something that we've proposed is that to help with the issue of compliance costs, I don't know if you've seen this, but there's a business advisory group to the OECD, and they've been saying that for some businesses, where they've got very small levels of sales, it can be quite difficult for them to track which country they end up in, particularly in lower income countries, where the distribution channels are not necessarily fully in their control. They often cannot track the sales. So we propose that in those instances that we would apply a simplification rule to allocate out those sales which can't be identified, and that would do away with some of the compliance costs here. So do I think we will get a tiered approach to the nexus? I think yes, to a degree. I think there will be a bit of a tiered approach wherever the numbers end up. Probably the most radical part of our proposal, I think, is, and this was to do with the two issues of the amount of profit to be reallocated and leveling the playing field around the issue of where routine profit is allocated. So we decided to create a new letter. So we've had A, we've had B, and the original proposals had amount C, albeit amount C has now become tax certainty and not an amount any longer. So we had amount D, but essentially our amount D built on proposals such as those from Procter & Gamble and Johnson & Johnson, where we said that for all businesses, there should be a return on sales allocated to the market jurisdictions. And the return on sales will be a sliding scale dependent on the global operating margin of the group. So again, perhaps easiest if I show you in the next slide. We didn't put any numbers in. So you can see in the dark green column on the left, if you've got a business that makes a profit between our profit operating margin at global level between 0 and X%, then it will allocate a return on sales of A%, whatever that percentage is. So this slide's purely illustrative, but that was our proposal. And we thought this, A, would be far, far simpler to apply. And secondly, it wouldn't matter now whether you've got a digital business with no physical nexus, or you've got a business with a physical nexus. They will both pay the same amount in the market jurisdiction. Now, we realize that I think that many countries would say, no, you can't do this because you don't have any functions, assets, and risks in the country to justify part of the routine return. And we don't really agree with that, because our view is that that's the whole problem, is that digital businesses don't have functions, assets, and risks in your country in the first place. And that's what created the whole problem in the first place. Will this happen? This is the one that I think has the least chance of getting accepted. However, what I do think is that we may make some progress over adjusting, in particular, what percentage of the residual profit might be allocated to amount A. So in other words, the so-called illustrative 20% may end up at more than 20%. And you can see that if you move the 20% to 30%, instead of having 100 billion profit reallocated, you end up with 150 billion profit reallocated. And I think if you look at the impact assessment, reducing the deemed routine profit, say to 8%, doesn't have a very significant impact on the amount of residual profit. It's more, you get bigger impact if you move the 20% deemed residual than you get if you move the 10% deemed routine. So in terms of quantum, we may get this proposal may help market jurisdictions to get more profit allocated to them. In terms of leveling the playing field, I don't think we're going to be successful, if I'm honest. Okay, so I've covered that, and I'm aware, and I saw Ariadna face come up, so she obviously is looking for me to stop fairly soon. So this here, I've got a slide. It does sort of just set out what we've been talking about, which is, you know, the alignment of what we've said with what the US has said. And as you have covered most of these, but a lot of alignment, I would say, in the area of how we simplify the rules. I think a big difficulty will be around what's said about tax certainty. So we've asked for an elective binding mechanism. This was in the blueprint for mandatory dispute resolutions issues relating to issues that go beyond amount A. We've asked for it to be an elective process for countries that have very low MAP inventory, on the grounds that imposing what will be a quite costly, resource-intensive mechanism where there may not be very much tax involved and the countries have very limited capacity. We think it's not a good approach. We don't think it's justified. Many of the smaller African countries, it'll be the same people who do the audit who have to do anything on this process as well. And that will divert their resource away from doing work to deal with profit shifting. So we're against having this approach for the smallest countries. Same time, if it's elective, if they do elect for a MAP case to go into the binding mechanism, then fair enough, they can do that. And that gives them a chance to also learn about the process. A lot of very strong opposition in most African countries to a mandatory binding dispute resolution mechanism for those reasons. And I think I've covered this. Greater profit allocation, yes, we want that. A large area of divergence for us was obviously on what's the global revenue threshold. US is at about 20 billion, and we suggested 250 million. That was based upon having our simplified amount D approach. It also depends on what happens with the mandatory binding dispute resolution discussions. And that is it. So let me stop there. And I think I've gone a bit over time. So, but if it's okay with Ariadna, I'll give you a chance to ask any questions you want. Thanks. And let me stop sharing.